أعوذ بالله الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. So this is going to be our last lesson for this course, and it is all about financial statement analysis. This lesson is very important because like 70% of your final exam will be from this lesson. So you have to really understand this lesson carefully. Now, in our last lesson, we were talking about the financial statements, and we said that in accounting, we have three basic financial statements. So we have the balance sheet, we have the income statement, and we have the cash flow statement. So now in this lesson, it's all about analyzing the contents that are inside the words, those financial statements. So that is what is basically meant by what? That is what is basically meant by financial analysis. So this is the lesson outline for this lesson. So number one, we shall be talking about the types of financial statement analyzed, the importance of analyzing financial statement, types of financial analysis, financial ratios, importance of financial ratios, types of financial ratios, and steps for interpreting financial statement. So this lesson is very, very long, but I will only be focusing with the areas that you will find in your exam. Now, number one is the definition of financial statement analysis. Last week, we had already started talking about it. So financial statement analysis, it is a process of analyzing a company's financial statement for the purposes of making decision, as we saw in our last lesson. And these are the three common types of financial statements. We have the balance sheet, the income statement, and the cash flow. So we've already discussed in detail about these three statements. And in our last lesson, we also answered the question as to why analyzing the financial statement is important. So this part in our last lesson, I explained in detail. Now, we also have the types of financial analysis. So we have two types. We have the horizontal analysis and we have the vertical analysis. I'll not talk much about this. So the most important thing I need us to talk about, what you will find in your exam next week. I think you'll be doing your final exam. Tomorrow you'll be doing your quiz. Now, I need us to talk about the financial what? I need us to talk about the financial ratios and metrics. So what are financial ratios and metrics? So financial ratios and metrics are quantitative tools used to assess a company's performance and financial health. So if we want to know if our organization or if our business is doing well, then we have to have this quantitative information. We have to analyze our financial statement to give us data that is going to help us to do what? To make decisions. So they derive from that they derive from data contained in financial statements, mainly the balance sheet, income statement, and cash flow statement. This is where we get the data to analyze and provide insight into various aspects of a company's operation, such as profitability, efficiency, liquidity, and solvency. Now, we have the importance of financial ratios. This one you'll just read during your free time. The steps for interpreting financial statement. Now, this is where I need you to focus more because this is what you are going to find in your next week. You'll find this in your exam. So we have the types of financial ratios, and these ratios, they are divided into five. So we have liquidity ratios, we have profitability ratios, we have the solvency ratios, we have the turnover ratios, and we have the earning ratios. So this, for each and every ratio, we have subsets in each and every branch. Now, number one, we are going to start with this liquidity, the liquidity ratio. So under liquidity ratio, we have the current ratio, we have the quick ratio, the cash ratio, and we have the operating cash flow ratio. So we are going to start with number one. I need you to focus. We are going to start with the liquidity ratios. Now, what are liquidity ratios? So in an exam, you can be asked, what are liquidity ratios? So liquidity ratios are financial metrics used to evaluate a company's ability to meet its short-term obligation with its most liquid assets. These ratios indicate how well a company can cover its current liabilities with its current assets, reflecting its financial health in terms of short-term solvency. So when we are talking about liquidity ratios, we are basically talking about metrics that help us to know if, as a company, we shall be in a position to meet our short-term obligation or our short-term liabilities. So all these ratios, the liquidity ratios, they always focus with what? We are always evaluating our current assets against our current liabilities to know that to enable us to know if we'll be in that position to do what? To meet our obligations. Okay. And we have the importance of the liquidity ratios. Now, talking about the types of liquidity ratios, we have the current ratio, we have the quick ratio. Another word for the quick ratio is the acid test ratio. We have the cash ratio, operating cash flow ratio, and the working capital ratio. So we shall be covering the quick ratio, the cash ratio, the operating cash flow ratio, then the working capital ratio. Now, let us start with the quick ratio. So in all this ratio, this is very important. In all this ratio, you will be given a formula. So in the exam, if you just get a question, you just apply the formula. Full stop. So I will give you the data to use. I will give you the information to use. So you just have to do what? You just have to use the data or the information given. So number one, we have the quick ratio. The quick ratio, another word for the quick ratio is the acid test ratio. So what is the formula? What is the formula for the what? What is the formula for the quick ratio? The formula is the current assets minus the inventory divided by current liabilities. That is the formula. So in the balance sheet, you will be given, I'll give you all this information. So example one, for example, you can be given current assets, $150,000, the inventory, $30,000, current liabilities, $100,000. So they ask you calculate the quick ratio. So you just apply the formula. The formula says quick ratio is the current asset. Our current asset is 150,000 divided by the inventory. You've been given the inventory, which is 30,000. Okay, then you divide by what? Current liabilities. Our current liabilities is 100,000. As easy as that. So the first example, you get what? 1.2. If you use your calculator, you'll get 1.2. Another example, you can be given current asset 300,000, inventory 100,000, current liabilities 200. Just apply the formula. If you just apply the formula, copy paste, you are going to get 1.0. Now, sometimes you can be asked to interpret what is the meaning of this 1.2. What is the meaning of 1.0. What is the meaning? So a quick ratio of 1.0 means that for every dollar of current liabilities, the company has $1 of current assets. So current assets minus inventories. This suggests that the company can meet its short-term obligation without relying on the sale of inventory. So in brief, what they're basically telling us, any figure, if you calculate and you get any figure above 1, then it basically means we can be able to meet our short-term obligation without being forced to sell our inventories. But if you calculate and you get minus, if you get a negative number, it means we cannot meet our short-term obligation. Cash ratio. The cash ratio, number 2 is the cash ratio. We also have the formula. So the cash ratio equals to what? Cash and cash equivalents divide by what? By current liabilities. So for example, in the exam, I'll just give you these figures. Cash and cash equivalents, I'll give you the amount. In this case, it's $50,000. Current liabilities is 100. So you just have to calculate the cash ratio. So the cash ratio will be $50,000 divided by $100,000. So in the first example, you get 0.5. The same thing, the second example, you'll be given the cash and the cash equivalents and the current liabilities. So you just do what? You just take the cash or the cash equivalents divide by the current liability. So in the first example, you have 0.5, and in the second example, 0.75. So what is the meaning? What is the meaning of these figures? So a cash ratio of 0.75 indicates that the company has enough cash to cover 75% of liabilities. And the first example, the 0.5, it means that our organization or our business is having enough cash to cover 50% of the liabilities. So the higher the figure, the better. If the figure is higher, it means that you have enough cash to meet all your obligations. If you get, for example, the figure is 0.2 or 0.1 or a negative is even worse, because negative means you don't have cash. So you cannot meet your liabilities. So the figure should always be positive, and a good positive. Now, then we have operating cash flow ratio. Also, the formula is very clear. So you have the operating cash flow divided by what? Current liabilities. First example, you have the operating cash flow is 120,000. The current liabilities is 100. So what is our operating cash flow? As easy, you just take the 120,000, which is the operating cash flow, you divide by what? 100,000, you get 1.2. You know? Then the second example, you get 0.8. If you just apply the formula, you don't have to think a lot. The figures, apply the formula, get the answer. So what is the meaning of this 1.2 and 0.8? So this is all about cash generation versus obligation. So a ratio of 0.8 indicates that the company's operating cash flow is insufficient to fully cover its current liabilities. This suggests that the company generates only 80% of the cash needed to meet its short-term obligation from its core business. And if that is the case, it means that you still have the other 20%. So all your operation, when you're talking about your operation, when you're talking about your core business operation, we are basically talking about the key activities that bring money to your business. That is the operation cash. So if you are getting only 80%, now what is going to happen to the other 20%? So it means there is a problem somewhere. So it's not a good figure. Now, the working capital ratio, this is very easy. So the formula for the working capital ratio, you just take current assets minus current liabilities. If you get a positive number, it basically means we have enough, our current asset can cover our current liabilities. But if you get a negative number, it means the liabilities are more than the asset, which is very dangerous. So in our first example, you have the current asset is 150,000, the liabilities is 100. So you just take 150,000 minus 100,000, you get 50. So it's a positive number, not bad. The second example is 300,000 minus 250. As easy as that, you get $50,000. Now, positive. If you get a positive number, it's okay. So positive working capital. So a working capital of $50,000 indicates that the company has more current assets than current liabilities, which is a positive sign. This means that the company has sufficient short-term assets to cover its short-term obligation. So that is, in brief, the meaning of this. But suppose you find that you have a negative number, a negative working capital, then it is a negative sign. And it means that you don't have enough money to cover your short-term obligation. Now, in conclusion, liquidity ratios are vital tools for evaluating a company's ability to meet short-term obligation. Full stop. So in this case, what you're basically saying is that we have, so these are the liquidity ratios: working capital ratio, operating cash flow ratio, cash ratio, and quick ratio. So there are four. So these four, we normally call them the liquidity ratio. Now, let us go to the second one. Number two, we have the profitability ratios. So what are they? They are financial metrics that assess a company's ability to generate profit relative to its revenue, operating costs, balance sheet assets, or equity. These ratios are vital for measuring a company's overall financial performance and are commonly used by investors, analysts, and management to evaluate operational efficiency and profitability. So these ratios, they basically help us to know if the business is doing what? If the business is doing okay, if the business is getting profit. So if I'm an investor, I will just go to the balance sheet or your income statement and I will calculate your profitability ratio. I will easily know if you are doing well, if your business is generating enough profit. I can invest with you. But the opposite is true. If I realize that you are not having enough profit or you're getting a loss, then it will be difficult for me to invest in your business. So let us see. So the profitability ratios, there are very many. The importance of this, you'll just read it later. So these are the types of profitability ratios. And for each ratio, you have a formula. So you just apply the formula, get the figures, easy as that. So you have the gross profit margin, the operating profit margin, the net profit margin, the return on assets, and the return on equity. So for each and every one of these ratios, you have a formula that you can use, and the formula will give you an answer, and you can easily interpret the answer. Now, number one is the gross profit margin. So what is the formula for the gross profit margin? So the gross profit margin is what? it is the gross. You first calculate the gross what? Gross profit, divide by revenue times 100. Again, gross profit divide by revenue times 100. For example, you can be given the revenue, which is 500,000, and you can be given the cost of goods sold in the exam as 300,000. Now, they will ask you to calculate to find the gross profit margin. So to get the gross profit margin first, you need to get the gross profit. So the gross profit equals to our revenue, which is 500,000, minus the what? Minus the cost of goods sold, which is 300,000. Okay, so this will be 500,000 minus 300,000, which will equal to what? 200,000. So this is our gross profit. Now, what is the gross profit margin? So the gross profit margin is the gross profit, which is 200,000, divide by what? 500,000, which is the revenue, times 100. So in our case, it's 40%. So number one, you have to calculate the gross profit because you are going to use the gross profit in the formula. And the gross profit, you can only calculate it. So the formula for getting the gross profit is the revenue minus the cost of goods sold. This is how you are going to get the gross profit, which you will use in your formula. So what is the meaning of this? A gross profit margin of 40% means that the company retains 0.4% from every dollar of sales after accounting for the direct cost of goods sold. This indicates a healthy markup and efficient production process. So the 40% means that for every sale, when you are selling something in your business, so for every dollar of sale, you retain $0.4 as your profit. You sell from every dollar, you have 0.4 as your profit. Every dollar, you have 0.4 as your profit. So if the higher the figure, the better. So it means you are retaining a lot from your dollar. So for example, if you have 0.8, it means your profit is very high. But if it is low, it means that for every dollar, you are retaining only a little thing, like 0.2 is not a good figure, 0.1 is not a good figure. So anything above 0.5, it's good. Now, the operating profit margin, the formula is also there. So the operating profit margin equals to operating profit divided by revenue times 100. As easy as that. So in an exam, you can be given the revenue, which is 500,000, the operating expense as 150, then the gross profit from our previous calculation, the gross profit, which is 200,000 from the previous calculation. So how will you calculate your operating profit? So the operating profit equals to gross profit minus the what? The operating expenses. So it is the 200,000 divided by 150, you get the operating profit. Now, the operating profit margin, what will you do? You are going to take the what? The 50,000, this one, which is the operating profit, divide by the 500,000, which is the revenue, times 100, you get 10%. So I'm going very fast because it's very easy. During your free time, just review the slides, review the formulas. The formulas are very direct and you will get the figures. So an operating profit margin of 10% means the company earns 0.10 on every dollar of sales, but after covering both the cost of goods sold and operating expenses. Now, the next thing, you also have the net profit margin. So the net profit margin, the formula is the net profit divided by the revenue times 100. Again, you will be given all these figures. You just apply the figures and there we go, you get your answer. The return on assets, and this is one of the most important profitability ratios. So the return on assets is the net income divided by total assets times 100. So in the exam, you'll get this net income, you'll get it. The total asset you'll be given. So you just take 50,000 divided by the 1 million times 100, you get 5%. As easy as that. So a return on asset of 5% means the company generates a profit of 0.05 for every dollar of total assets employed. So for every 0.0, so again, a return on asset of 5% means the company generates a profit of 0.05 for every dollar of assets. So for every dollar of assets, we get 5% of profit. For every 0.05 of the assets we are having, we get 5% of profit. So the return on asset basically help us to know how effectively are we using our assets to generate income. Because sometimes as a business, you are having a lot of assets and these assets are not generating income. For example, you might be having a business, you have like three empty rooms. You are not using these empty rooms. So you have assets, but these assets are not giving you any income. Or maybe you have these assets, but they are not giving you enough income. So as an organization or as a business, always ensure you are using your asset efficiently to help you get profits. Then the return on equity. So the return on equity is the net income divided by shareholders' equity times 100. So you'll be given the net income, you'll be given the shareholders' equity. So the formula is 50,000 divided by 500 times 100. What do you get? 10%. So this 10% means what? A return on equity of 10% indicates that the company generates a profit of 0.10 for every dollar of equity invested by shareholders. So for every dollar invested, we get 10% of profit. For every 0.10 invested by our shareholders, we get 10% of profit from it. Now, the profitability ratios are essential tools for assessing a company's financial performance. If you want to know how well you are doing, then you need to know the return on equity, the return on assets, the net profit margin, operating profit ratio, and the gross profit margin. So they are known as the what? They are known as the profitability ratios. Now, the solvency ratio. This is number 3. So we have only 10 minutes remaining. So what are the solvency ratios? The solvency ratios are financial metrics that assess a company's ability to meet its long-term obligation. The solvency ratios are the opposite of the liquidity ratios. The solvency ratios are the opposite of the liquidity. Liquidity ratios, they show us the ability of a company to meet its short-term obligation. But the solvency ratio, this solvency ratio, it basically helps us to know as a company, as an organization, can you meet your long-term obligation, the loans, for example, you take from the banks? Are you in a position? So again, there are around 4. We have the debt to equity ratio, debt ratio, interest coverage ratio, the equity ratio, and the financial leverage ratio. For each one of these, you also have a formula. You just apply the formula. So the debt to equity ratio is what? It's total debt divided by the shareholders' equity. As easy as that. So you have in this case 300,000 divided by 700. The debt ratio is total debt divided by total assets. As easy as that. And all these figures you get, this one you can get it in the balance sheet. The interest cover ratio. This is the earning before interest and taxes divided by the interest expense. You just divide, you get the answer. As easy. So the exam is going to be very easy next week. You just apply these formulas and you get the answers. Then we have the equity ratio, total equity divided by the total asset. Masalam, you get the answer. The leverage ratio is total assets plus total equity. You get the answer. So this is it. So in your exam, you will find these three types of ratios: the solvency ratios, the profitability ratios, and the liquidity ratios. So that is what you will find in your final exam next week, Friday or Thursday, I'm not sure. So that is the end of this course, our business accounting course. Now, if you've been attending all the lessons, so you have the 20% for the attendance. Now, tomorrow, you will be doing your quiz. I will send it exactly at 8 o'clock. So be online, because it will be from 8 o'clock to around 9 or 9:30. After that, I will enable the link. So you'll have like 1 hour, 30 minutes for the quiz. If you get all the questions, then you have the 20 marks. So that is 40, the attendance plus the quiz. Now the final exam, it will be out of 60%. So it's very easy to get the A+ in this course. It's very easy. So I think that's the end of the question. That's the end of our course. And if you have any question, please, you can ask as I take the attendance. We still have 5 minutes. So if you have any question, please, you can ask about the course, about the exam, about the quiz. You can just ask as I take the attendance. Yes, please. Any question? Yes, please. So there are some students. Hello. Yes, welcome, please.
How many chapters are we opening the final exams?
Only 2. This chapter and the last chapter, and the chapter that we covered. So this is lesson 6. So it is 5 and 6. The financial statement and the financial statement analysis. So your final exam, only these two modules. Your quiz will be 1, 2, 3, and 4. Your quiz tomorrow will cover those 4 modules. But the final exam will only be the financial statement and the financial statement analysis. This lesson and the last lesson we covered, lesson 5 and lesson 6. The quiz will be lesson 1, 2, 3, and 4. Yes, Abdullah, what's your question, Abdullah?
Teacher, last lesson is I think 50 slides. So that lesson is sub party like 5, 6, 7.
I can't get you.
Module 5, 50 pages for slides.
Yes, this is what we have discussed today. Today was module what? The last lesson that I've sent in your group is module what? The lesson that I sent today is module what? Module 6. Module 6A. Financial statement analysis. This is what we were covering today. Module 6. Okay? Then, what we covered the last lesson was what? The last lesson, module 5. Module 5. Do you have that module 5? It is also 50 pages, yes. So those two, module 5 and module 6, will be in your final exam. Did you understand?
Okay, okay, yeah. Thank you.
Yeah, module 5, the 50 pages, and also today, also. Those two. Today is also 50, yes. So those two lessons will be in your final exam. But your mid-semester will be the other modules, 1, 2, 3, and 4. That will be tomorrow at 8 o'clock.
Teacher.
Yes, Abdul Samad, or who? Abdullah was? Yes. Now.
Yeah, teacher. Some of our students is not especially for finance or economics or business, maybe other faculties. So, what will you advise about this subject or this course in the future? Like me, I'm a computer science graduate from my bachelor.
Yeah, of course, I know this course, all the students they were sharing, but I think it's one of the most important courses, regardless of your area of specialization, because all of you maybe in future, you'll want to run a business. Maybe you are in computer science, but maybe you are having you are having a business related to computer science. Maybe you are a consultant in computer science, or maybe you are selling electronics, the laptops. So whatever you are doing, you will need this background. It will help you with the money. So even if you are in because maybe some of you, maybe you are having a background in maybe nursing or a project manager, you will need to know the finance, how the project is going, how the money is being used, the assets you are having. So regardless of your area of specialization, you will need to have a background in accounting. You will need to know how your business is doing, how your project is doing. So it's very important, and that is why I think all of you are doing this course, and that is why this course, it will be 8 p.m. 8 a.m. is in the morning. The exam will be 8 p.m. Your normal time, the exam will be at night. So that is why I did not go deep, because if I was teaching this course deeply, it could have been very unfair, because some students, they don't have the background in accounting. So that is why I was giving you just the foundation. I was giving you a foundation. I did not go deep. And even the exam, you will find it is not detailed. The exam, even if you don't have a background in accounting, still you can do the what? You can still do the exam.